All right, good afternoon, everyone. This is Eric Milliken once again with Market Share Financial, and we are doing our Wednesday webinar this week on utilizing and leveraging our insurance division for your holistic planning practice. We're just finding that more and more advisors, especially FINRA licensed advisors, really can leverage and utilize our vast resources and our team for going back to their existing book of business and reaching out to their clients about their current insurance policies as they stand today, maybe where they have some gaps, but also looking at other important topics such as long-term care planning, disability income, and of course the non-securities annuity space, specifically in the fixed annuity space. Those have obviously become a very attractive product for the right situation. So knowing that we have a tremendous team and we built this team specifically to really kind of feel like a one-stop shop when it comes to the non-broker dealer business, but also for the broker dealer business as well. So we felt it was important to maybe reintroduce the team, the resources, some trends, and some of the activity that they are seeing today, and then make sure that you also see through some case studies and some work that Valerie has done, getting a sample of some of the things that they're currently working on in today's environment. I'm going to start just briefly by sharing my screen as well. I'm just going to pull up a specific document here that we put together for Market Share to help promote how we view and how we look at holistic planning for advisors. So as you can see, through our broker-dealer relationship at Royal Alliance, we obviously have their full open architecture platform when it comes to the brokerage side of the business for all of your variable annuity mutual fund and of course, full stock bond option and equity business in general. Then, of course, for those that are Series 65 or 66 licensed, CFPs operating in the wealth management side, specifically on the advisory platform, a wealth of resources when it comes to product offerings there as well. And obviously we could spend a whole nother webinar just on that platform. But we round it out, of course, through our protection solutions and other insurance related needs. So that full circle of planning is something that Market Share for years has adopted, but we're trying to be more in front of our advisors now so that we can, of course, make sure that you're not missing the mark, especially in the fiduciary and regulatory environment that we're continuing to move forward in. Doing things in the best interest across all areas of the holistic planning process is extremely important. Making sure that you as the financial professional is doing everything in your power to making sure that you're handling all of your clients' needs, and of course, retaining your clients, making sure that they're not looking elsewhere to have certain components of their planning process taken care of. They should be able to know that you have the tools and resources at your fingertips to go ahead and facilitate that for them. So I just wanted to make sure that we give you a little bit of a visual here of the things that we think of and that we work on. These are the items that we put in front of prospective advisors as well that are looking at how Market Share Financial serves both the insurance advisor as well as the financial advisor / financial professional. So if this is a PDF that is of interest to you to have at your fingertips or share with other individuals that you know that you might be talking to Market Share Financial about, feel free to let me know. We do have this on our website, but I can definitely email that to you in a PDF file. No problem there at all. So I'm going to go ahead and tee up David Chaup, who is going to talk a little bit more in depth about his team members and how they support our advisors today and give you a little flavor of what that looks like. And he's also going to talk a little bit more about some of the current activity, some of the trends that he's seeing, especially in this unique environment that we're in today, how this has helped shape some of the conversations that he and his team are having in helping their clients plan for the unknown, the potential situations that could arise in the future. We obviously went through this for the last few months, and I think he's got some great ideas to share with you. So I'm going to go ahead and turn it on to David, and then we'll of course pass the ball over to Valerie for a very in-depth presentation that she's put together for us. So David?
All right. Well, Perfect. Thanks, Eric. I appreciate the opportunity to present today. Eric had asked a few weeks back if we could go through and just kind of give everybody an overview of the platform and really the resources that are available with respect to the insurance division. I know the piece that Eric just put together there does a nice job of explaining really the value of having a complete holistic planning approach, and that's really what we've tried to accomplish within our insurance division. We really look at the insurance planning process as a complement to the securities practice, and so that there really is no holes in an entire, real planning process as you sit down with your clients. And we've really found that as long as our advisors are aware of the resources available to them, it just makes them that much more valuable to their clients, and so that there really is no reason for a client to go elsewhere for insurance planning products, such as Eric mentioned, with long-term care, disability income, and really any of the fixed annuity products, and of course life insurance. So I just prepared a couple of quick slides today just to kind of give you again a brief overview of the resources available to you. And then I'm going to turn it over to Valerie to talk a little bit about a couple of case studies and some of the ways that income annuities can help complement a retirement portfolio. So first of all, I'll go in and share my screen here real quick and pull up the presentation. Sorry, back up 1 second here. There we go. Oh, sorry, it's click on the PowerPoint. Let me back out of this real quick. Okay. If everybody can everybody see my screen okay? Okay, well, perfect. I'm going to start here at the beginning. So for those of you that have had an opportunity to see me present in the past, this is a slide that I literally include in every presentation. And the reason for that is this is really the sampling of everything that's available and what we really refer to as the holistic planning process. Now, I always mention, we really don't get involved at all in the health insurance world and of course, auto insurance and homeowners, but really everything beyond that are the different steps that any of our advisors have access to the information and to the resources available to us. So just talking briefly about our team and just the overall structure of our group. Myself and Mike Hutto, which I know a lot of you have probably worked with, really handle the majority of the case design and illustration work. We have Jen Boudreau and Joe Brita as the two individuals that are responsible for case management and underwriting. And then Valerie McWilliams joined our team at the beginning of the year as really our dedicated resource to the annuity side. So as I look at this list of different planning opportunities that are out there, really the resources are available to you on all aspects of the insurance planning process that I talked about. The security side, of course, is a little bit different. You have resources like Eric Milliken, Jermaine Clemens, Jill Daly that can help on the security side. But I just wanted to, again, include this slide so it might help to jog your memory, or at least help you think of specific clients that are out there that you might want to work with on some of the different planning steps that we talk about today. This really is kind of the crux of what we do for the majority of our advisors. So, how can we help? A lot of our advisors are really not aware that we do specific one-on-one case consultation, and that, jumping down to the second bullet point here, the joint calls and the split case opportunities are always available to you. So we get a lot of advisors that call and say, David, I'm not necessarily comfortable talking to my client about disability income or some of the different aspects of the long-term care planning process. We can do that work for you with a simple call directly to the client. We have no issue whatsoever talking to the clients, and in some cases completing the applications and doing the entire sales process. Now, of course, if that was the case, we would probably arrange a split case opportunity if you wanted us to handle the entire thing. But just know there's never a situation where, if you're not comfortable talking to your client about disability income options or long-term care or some of the annuity things that Valerie will be sharing with you, we can do that for you and make sure that you look as an expert to your clients, that we got everything really covered on all aspects of the product information, the sales process, and completing the case for you. A couple of the additional things that are listed here, competitive intelligence and product research. Mike Hutto is a fantastic resource for that. If you come across a scenario where you might be competing with say a Northwestern Mutual advisor or any other, rep that's out there presenting a different company, send that information over to us. We'll pull it apart for you, do all the product research, and make sure that, again, you're put in the most favorable light in front of the client. A couple of the additional things that are listed here, the customized sales collateral. If you have a specific logo or any information that you'd like to include, we can put that on some of the spreadsheets, make it look as though everything that was completed was done specifically by you and that we're just your back office support for that material. And then finally, the last two things that are listed here, the underwriting analysis and medical discovery calls. We have our chief underwriter, Joe Brita, on staff that is literally one of the best experts in the industry when it comes to underwriting. And Joe can help position those cases with the carrier. If you get him involved, have him do a medical discovery call with the client, we'll make sure that we're presenting the case and putting it again in the most favorable light to get the best possible outcome on a case. And then finally, the in-force policy review section that's listed here. This is one area where I think a lot of advisors really have not taken full advantage of the resources available to them. If your client has any form of insurance, whether that's life insurance, DI, LTC, a simple question to ask them as you're sitting down with them to do annual reviews is, do you own any in-force life insurance, LTC or DI? And if so, when's the last time you reviewed it? Odds are that they've maybe purchased a policy 10, 15, some cases 20 years ago and have literally put it in a file cabinet and haven't done anything with it. We can go back in and do an in-force policy review on that contract and let you know if that's still the best possible opportunity for coverage for them. And in a second here, I'll talk about the reasons and why that's important as you potentially reposition policies for different needs down the road. So again, I just wanted to throw this slide together for you just so you might not realize all the opportunities that are available to you as far as the market share staff is concerned. And I just mentioned some of the folks that are more than willing to help you out with any of the things that are listed. Now, the final slide before I turn everything over to Valerie is I wanted to talk briefly about some of the opportunities that we see here in the summer here of 2020. Obviously, it's kind of been a crazy year with respect to the coronavirus and everything that's gone on. Forced us all to kind of, change our ways as far as our daily work habits and routines. But these are some of the areas that I think, as we go into, the middle parts of summer here and heading into the fall, are some great opportunities for you to get back in front of your clients and talk to them about some of the insurance planning opportunities. First one I mentioned, the policy underwriting and performance reviews. We're finding a lot of success with folks that are going in and looking at those in-force contracts. We will audit those for you and give you an analysis to compare what they have currently to what's available in the market today. So a huge opportunity not only for your existing book, but for clients, again, that may have purchased insurance elsewhere. Second opportunity would be reviewing business insurance arrangements. This is something that I'm seeing more and more of as I talk to our advisors. They've got a lot of business owner clients that either A, have drastically increased their business over the last 5 to 10 years just because of the booming economy that we've had, or B, here in the short term, they have had some changes internally where they've had to reallocate staff, in some cases, of course, let go of staff. And some opportunities you'll have there are to go in and look at those people that have key person arrangements or buy-sell arrangements and go in and reevaluate those for them. Likely their business value has changed, hopefully for the positive. And if so, it's a good opportunity to go back and talk to them about going in and reevaluating that buy-sell arrangement and potentially increasing coverage because the value of the business is much higher today. So don't forget about those clients that you have that are business owners. There's a lot of things that have changed for them, a lot of decisions that they've had to make with respect to the PPP loans and some of the things that have gone on in the business world. But a great opportunity, again, to talk to them about their business insurance arrangements and essentially audit those. The last two things here that I've listed, the cash accumulation insurance for retirement income, again, is a great way to get back in front of clients. There's a lot of people that were really spooked, by the market here over the last, 3 to 6 months. They've had their investment portfolios drop drastically and in some cases bounce right back up. A great way to create a little bit of diversity in their portfolio is to talk to them about some of the permanent insurance planning products that are out there in case they don't want 100% of their assets tied to the market. A great way to implement a permanent, whether you're talking a whole life policy, universal life contract, in some cases IUL, as a way to just say, let's carve out a part of our retirement income stream and utilize permanent cash value insurance to do that. So a great opportunity right now because a lot of people, again, have seen drastic fluctuations in their investment portfolios, and they may want to look at potentially carving out some of that for different types of insurance planning opportunities. And then the final opportunity that I see here for the summer of 2020 is looking at opportunities for long-term care insurance and implementation into a combo life insurance product. And I say that because think again about all those clients that were out there that potentially had, whether it's themselves or parents that were in nursing homes and went through this whole coronavirus epidemic. How likely would they be, or how much would they have preferred to have been at home and had home health care done with, in some cases, the balance from a long-term care policy. So it's a great talking point for folks right now, just because there's a lot that as they looked at that, that was really kind of a nightmare scenario. They were in nursing homes. They had the coronavirus in some cities just rifling through and obviously impacting those nursing homes to a very high level. Great opportunity to talk to those folks right now about home health care and what that could do for them if they had a long-term care policy, whether it's a hybrid policy, like a MoneyGuard contract that has a combo LTC and life insurance, or just a life insurance contract that has a long-term care rider associated with it. And those policy reviews that I talked about, if you do a 1035 exchange from those contracts, you can add on a long-term care rider and cover an additional need for those clients. Great planning opportunity for folks that are in that 50 to 60-year-old age range where maybe their life insurance needs have changed, kids are out of the house, and now they're looking to look at that next phase of their insurance planning. So those are just 4 quick things that I wanted to share with you today. I'll end the screen share here, and we'll get back to the rest of the presentation. But if there's any additional questions, feel free to fire those off to myself or Mike Hutto. But from here, I will turn it over to Valerie to share her thoughts with respect to income annuities and retirement planning. So, Valerie? Valerie, I think you're on mute here if you're talking.
All right, can you hear me now?
We got you.
All right, great. And are you seeing the screen about retirement and annuities?
We sure are.
Yes.
Perfect. Okay. All right, so when I think of annuities, I can't help but think of retirement and how it goes along with it. So I really wanted to focus first on retirement and what that means to both the fee-based advisor and to the retirees. And then I wanted to take a look at some case studies on some different annuities and how it can impact the overall portfolio. So go ahead and get into it. Here's some disclosures first. I'm sure you can read all of that. Okay, so when looking at retirement, I think of it as a mountain. And the overall goal of climbing a mountain, if you ask most people, is to get to the top. And while it's certainly part of the goal, the real goal is not only to get to the top, but to climb back down safely again. And not only do clients want to retire one day, but they also want to not run out of money in retirement. And that's actually been one of the top client concerns over the years, is not running out of money. So naturally, when clients don't want to run out of money, they ask the highly Googled question of, how much money do I need to retire? And there are many different practices financial professionals use to help the client accumulate as much money as possible during their working years. But there is no exact answer on how much clients would need to start retirement. You say, why is that? Well, there's 2 questions that can't be answered. First, how long will I live? Second one, what will the market do when I'm retired? Both you and your clients don't have the answers to these, but you have to plan for it anyways. And if these two questions could be answered, it'd be really easy to plan for retirement. So while most financial professionals can get clients up the mountain, as accumulating money is focused on so often during the client working years, how often can financial professionals help clients with decumulation or getting back down the mountain when clients are no longer actively earning an income? Let's look at the equipment. Find 6 differences between these two pictures. The only difference is you. There's no difference at all. It's not the gear. Everybody has access to the same thing, but by understanding different ways of using the client's accumulated funds to help them not run out of money, you are the main difference. The other thing I want to focus on is retirement happiness. So even if you develop a great retirement plan, if clients aren't happy, they either won't follow the plan or they will leave you for another advisor. And according to research, there are 3 main areas that make retirees happy. They want to know that they have dependable income throughout their entire retirement. They want to be healthy enough to enjoy what they're doing, whether that's golfing, traveling, gardening, coaching their grandkids' soccer team. And then the last thing that makes a big difference in retiree happiness is knowing they will be socially happy. They ask, who will I eat dinner with? Or who will I spend the holidays with? And while you're not their primary care physician or social coordinator, you do have an impact on their income. So how do these 3 pillars translate financially, and what does that mean for you? If the client goal is to avoid running out of money in retirement while leaving the largest possible legacy behind at death, which is quite often a goal I hear when I talk to advisors, then income annuities play a crucial role. Most conversations around money in retirement are about accumulating wealth to support some level of retirement spending instead of talking directly about locking in your client's ability to spend. Mutual funds and other market investments offer the opportunity to take risk, not to eliminate it like pensions and annuities do. The research proves that a portfolio of only stocks and bonds was actually least efficient in accomplishing the client's goal in retirement. And the most efficient was a portfolio of stocks and income annuities. In this research, efficiency was measured by having the goal accomplished while encountering the least amount of risk. And according to the research, a good rule of thumb for buying annuities is to have 50% of bonds replaced by annuities 10 years out from retirement and 100% replaced by the time the person actually retires. So you're saying, how can we plan for that? Planning for longevity risk can actually help reduce many risks as shown in this graphic above. Longevity risk must be off the table as it compounds the risk of sequence of returns, inflation, long-term care, as well as a few others. And if you recall the past 2 questions that can't be answered and the retirement happiness research, you will understand why these 3 items were singled out as they address how long a person will live, what the market may do, and a retiree's health and personal spending. While stocks, bonds, and CDs can't do it, an annuity can. Here's a graph just showing you the sales of annuities based on stock market returns. And while it doesn't have 2020 in there, you can imagine what it may be. So with this research in mind, let's examine different income annuities and how it will impact the overall portfolio. In the following slides, we'll examine different case studies comparing a fee-based only account to a fee-based account that also incorporates an income annuity. In each one of the aspects we discuss, we'll have commissions, and please keep in mind, commissions in this presentation were representative of May 2020 and are an average. Commissions will vary by company, premium amount, and client age. Always check with market share for updated compensation rates, and note these ranges are subject to change. So keeping that in mind, the following case studies, your client has $1 million in their account that you manage, and with your help, they determined that $60,000 was enough to live on each year. They are wanting to not run out of money when they are retired and leave a legacy if possible. Keeping all this research in mind, let's examine multiple ways that this could be accomplished. We're going to look at what this means as they age, when they purchase the annuity and when they retire. And from there, we'll examine how much retirement income is protected and guaranteed. And in all these assumptions, I assumed a 1% managed fee for commission. Also, when looking ahead, I projected a 6.9 total return in the fee-based account, as that is the historical total return. So over time, you're going to see these in the case studies. Let's get started with a SPIA. So at age 65, this person retires. Your client has waited to make a decision to secure income, and they decided to start immediately. If your client took a portion of their money and purchased a SPIA from their $1 million, they would receive approximately, from the main numbers, $1,494 per month, which tallies to $17,928 per year. When you add in Social Security, you took $300,000 and purchased the SPIA, as according to the graph. When you add in Social Security and the annuity money together, your client would need to take out $22,072 from their fee-based account that year to make the $60,000 worth of income. That is half of what they would have to take out without the annuity. But by adding a SPIA, you increase their protected income by 30%. And you increase their guaranteed income by almost 50%. Overall, this lessened the portfolio withdrawal rate, which increases their chance to leave a legacy. For the second scenario, your client waited until they were 5 years out from retirement to make a decision to secure some income. If your client took a portion of their money out and purchased a DIA with that $300,000, they would receive $22,509 per year. And 5 years from now, when adding Social Security and the annuity money together, your client would need to take out $17,491 from their fee-based account that first year of retirement to make that $60,000 of income that you both determined. By adding a DIA, you increase their protected income by almost 40% and increase their guaranteed income by over 50%. And while this does lessen the portfolio withdrawal rate percentage, it is not important now, as the client is still working. It will be more important when the client retires and starts to withdraw from their portfolio. Deferred income annuities can earn anywhere on average between 1% and 5%. So in this scenario, $3,000 to $15,000 one-time commission will be earned along with the 1% fee-based commission. And as this is the first case scenario that has an annuity purchase pre-retirement, let's take a look forward 5 years based on 6.9% increase to the total return in the portfolio each year. This would show that by the time the client turns 65 and retires, they will start to draw in income from the annuity, Social Security, and the fee-based account. The portfolio has grown almost back to where it was prior to the annuity being purchased. And as the client was still in the pre-retiree phase and accumulating money prior to this day, investment withdrawals were not factored into the portfolio growth. Overall, by adding the annuity, it decreases the portfolio withdrawal rate to 1.79% when they decide to retire. And this could allow the client to have an increased income while still accomplishing their goal of not running out of money and leaving a legacy. So adding a DIA can help your client achieve their goal, benefit your client as removing less money per year from the managed account. So that's SPIAs and DIAs. Let's take a look at a fixed indexed annuity. If you spoke to your client and they were 10 years out from retirement and took a portion of their money, that same $300,000, and purchased a fixed indexed annuity they would receive approximately $27,525 per year through an income rider. By adding the FIA, you see that you have increased the overall protected income by 40% and their guaranteed income by 60%. And again, while this doesn't significantly lessen the portfolio withdrawal rate, it isn't important now because they're not retired. They're still working for 10 more years. So let's take a look forward to age 65 based on the 6.9% increase to what this means when they actually retire. Here you can see that adding a FIA annuity actually decreases the portfolio withdrawal rate to 0.91% and the protected income at 79%. They could undoubtedly increase their withdrawal each year, gift money to beneficiaries now, or further protect their income and yours. Because adding a long-term, by adding a long-term care policy or putting more money into maybe life insurance, something, but you can certainly see that they have a lot of options when they did it this way. Speaking of long-term care, there are long-term care annuities that provide income to pay for qualified long-term care expenses, such as in-home care, all the way through nursing home care. And if your client thinks that long-term care insurance is expensive, they should try not having it. All kidding aside, a linked benefit annuity is important to consider as health is a pillar to retirement happiness, as you recall. Your client waited until they were 10 years out from retirement to make this decision to purchase a health, to secure some income for a health-related event. And if your client took a portion of their money and purchased the linked benefit annuity, they would receive approximately $97,260 per year for the rest of their life if they encountered a long-term care event at age 55. And while this wouldn't really impact the desired income each year, it would greatly impact the managed money if the client encountered a long-term care event. Each year the client didn't trigger the benefits increase. For instance, if a client first has a qualified event and can't perform 2 out of the 6 ADLs at age 65, then $107,424 would be given per year for the rest of the client's life. Linked benefit annuities can earn, on average, anywhere between 3 to 6%. So in this scenario, $9,000 to $18,000 one-time commission was earned along with that 1% fee-based commission. Taking a look forward to age 65, this didn't really do anything for their protected income. You can see the percentage is still the same, but again, if they encounter a long-term care event, it's a way to take a lot of risk off the table. Lastly, I want to take a look at variable annuities. They can earn anywhere on average between 6 to 7% with no trails. So in this scenario, $18,000 to $21,000 one-time commission along with the 1% fee-based commission of $7,000. And you can see in here, $15,000 could be earned with a VA, and that's per year at age 55. Let's take a look forward at age 65. They'll draw income from the annuity, Social Security, and the portfolio, and it overall can decrease the portfolio withdrawal rate to 1.83%, and the protected income is at 58%. So just like the previous annuity case studies, they could undoubtedly increase the withdrawal each year, gift money to beneficiaries now, or further protect their income and yours by adding a long-term care policy to their portfolio. So what does this retirement and annuity case studies really mean? When reflecting on the client's goals, which were to not run out of money and leave a legacy, probably like a lot of your clients' goals, by accounting for longevity, by adding an income annuity, we increase the protected income in each scenario, as well as the guaranteed income. And this will lead to happier clients as they will have guaranteed lifetime income, which means they won't run out of money. The amount the client leaves beneficiaries will depend on quite a few factors, such as how the market performs, especially early on during retirement, if the client has an LTC event, or what type of care and how long they might last. And then if you and the client decide to withdraw more than $60,000 each year, income annuities pull quite a bit of risk off the table when accounting for all of the risks one could run into during retirement. So considering all the research and thinking about incorporating some of your client's money into an income annuity, I think it could benefit both you and your client. And with that, I will go ahead and wrap this up. Thank you everybody for attending today on this webinar. Eric, do you have anything further?
Yeah, just quickly, I do want to thank everyone for their time today. As you can see, there's a tremendous amount of opportunity out there to go back, revisit with your clients, revisit their current situation as it is today, but look further into their family dynamics, how they're feeling about today's current environment, current markets, and then start looking to the future. As you can see through some of those case studies, some pretty dramatic numbers and ways to definitely benefit the client and introduce some ideas to them that maybe they weren't aware of before. And of course, that's what they rely on you for. So not only are they relying on you, but they're able to rely on us. And I think that's why we always want you to know that we're in your corner. And our Market Share Financial team is definitely dedicated to making sure that you're successful in achieving the goals and achieving the retirement goals of all of your clients. So as David mentioned, as Valerie mentioned, go back during your reviews, ask them to bring current statements, ask them to, visit with you on subjects that you haven't discussed, in the past with them, and then bring our team in to see what we can do to help you further advance your relationship with your clients and solidify their futures for many years to come. With that being said, we'll go ahead and end the recording here for today. This will be recorded as well, so if you ever need to revisit or share it with someone, please feel free to do so. It will be on the Market Share website. And with that being said, I hope you all have a great rest of your day. Thank you.